Understanding kill orders in trading. In the world of trading, the term kill refers to a request made by a trader to cancel a trade after it has been placed but before it has been executed. This mechanism plays a crucial role in ensuring that traders have some control over their trade actions amidst the often volatile and fast-moving financial markets. What is a kill request? A kill request becomes necessary under several circumstances. 1. Market volatility. Any sudden changes in market conditions can drastically alter the potential profitability of a trade. If a trader recognizes that the market is moving against their initial expectations, they might issue a kill order to prevent losses. 2. Accidental orders. In a landscape dominated by rapid trading and computer algorithms, it is possible for traders to place orders accidentally. A kill request allows them to reverse unnecessary placements. 3. Changed mindset. Traders may re-evaluate their strategies or positions after placing an order, leading them to reconsider their commitment to that trade. The ability to successfully execute a kill order significantly depends on the market type and the timing of the request. Electronic trading systems often fulfill orders almost instantaneously, which can reduce the time window available for a trader to successfully kill a trade. Additionally, during periods of high trading volume, delays in communication with exchanges can hinder a trader's ability to cancel an order effectively. The importance of timing. When a trader places an order, they become liable for that order once it is fulfilled, irrespective of whether they have received timely notification. Thus, it is critical for traders to act quickly. If a kill order is submitted after the trade is executed, it will not be honored. As a result, traders must understand the implications of their strategies and the timing of their orders. Types of orders and killing mechanisms. Market and limit orders. Kill orders are influenced by the type of order being placed. There are two main categories: market orders and limit orders. 1. Market orders. These are executed at the current market price, and the execution happens almost instantly in most cases. This means traders have very little time to issue a kill request before their trades are filled. 2. Limit orders. This type of order allows traders to specify a particular price point at which they want their order to be executed. Limit orders can provide a greater time frame for traders to cancel an order since they are only fulfilled if the market reaches the specified price point. For example, stop-loss orders are designed to limit potential losses by selling an asset when it falls to a certain price. Take-profit orders allow traders to lock in gains by selling once an asset reaches a predetermined higher price. Both these order types allow for more flexibility, where killing the order prior to execution is more feasible compared to market orders. Fill or kill orders. A specific type of limit order known as a fill or kill (FOK) order is designed for traders aiming to execute large trades at a set price. The criteria for FOK orders are stringent: either the entire order must be filled immediately at the specified price, or it is entirely killed. This trade-off between execution and cancellation allows traders to manage their risk and gain better control over their investment decisions. Conclusion. Kill orders serve as an essential tool for traders looking to navigate the complexities of the financial markets. By understanding the various aspects of kill requests, including their timing and relationship with different order types, traders can better manage their risks and make informed decisions. The ability to cancel trades before execution is vital for maintaining control amidst the rapid changes that characterize trading environments today.